Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Karen McCormick of Berengia to talk about the Proven VCTs. Hello Karen, welcome to the studio again. Firstly, for those who aren't familiar, could you give us some background to yourself and Berengia?
Yes, of course. Good morning, Jonathan. Berengia is the manager of the Proven VCTs. The Proven VCTs are two venture capital trusts which have about £300 million under management. We aim to deliver a 5% year-on-year return. We've exceeded that historically in most years. And we tend to invest in early stage growth capital companies, which for us means businesses with proven traction, generally about £1 million plus in trailing revenue, and with a proven commercial management team.
And Berengia as a whole, it's a UK-based company and a US-based company, which is slightly different to some VCTs.
Yes, that's right. We have about over a 30-year track record in both the US and the UK. And so one of our USPs is to help entrepreneurs take businesses from the UK and commercialize them into the US. And that can be on-the-ground help with things like introductions to accountants, lawyers, commercial introductions to potential customers or suppliers, as well as things like market insights. What are the competitors doing? Where direction is the market going, et cetera.
And your own experience then? Chief
Sure.
Investment Officer of Berengia. How did you get there?
Yeah, I've been with the Proven funds for, I believe, going on 15 years now. Before that, I worked in consulting, most recently for the Boston Consulting Group. Before that, worked on a couple of startups myself and ran a P&L for a growth business.
So the Proven VCTs then, what are they looking to invest in? What companies are they looking for?
So the Proven VCTs, as I mentioned, like to invest in early stage growth capital businesses, which for us means not pure seed or startup, but really businesses that have commercial traction. Most of the companies we invest in will have somewhere between about 1 and 15 million in revenue. Can be a little bit less, can be a little bit more. And we tend to look for companies that can get to profitability or self-sustaining off the back of our investment. That's not always the case. Sometimes we will take a little bit of an earlier view or higher risk businesses. But for the most part, we're looking to invest in companies that have proven commercial traction.
Are there any particular sectors that you quite like?
Sure. In terms of sectors, about a third of our portfolio is in consumer and consumer related, and it continues to be a strong area for us, in part because the valuations have historically been slightly more controlled than, say, on the technology and software side. That said, about a third of our portfolio is in SaaS and software businesses, and then the other third is kind of a mix of things that are technology related.
Yeah.
So things like fintech or health tech.
And so what are you looking for in terms of a management team within these companies? What do you like to back?
Sure. For us, qualities that are important in the management team, one is an ability to scale, and generally these are early stage companies. So we aren't necessarily going to see a CEO who has scaled from 1 million to 100 million, although in some cases we do back repeat entrepreneurs who have that experience. But what we like to see is that they've been able to take the business from start to delegating and building a team around them to whatever stage they are at the time that we invest in. And then also that they are able to take on advice and experience from the management team around them. So are they hiring people who have either deep sector expertise or who punch above their weight in terms of general career track record?
So Karen, can you give us some examples of companies that you've backed recently in the VCTs?
Sure. Both 2021 and 22 have been quite busy years for us. This year we've backed, I believe, 6 companies to date, and they do span some of the sectors I talked about before. So consumer, a business called Lucky Saint, which is a non-alcoholic beer brand, one of the best we've ever tasted, and they're doing incredibly well, and hopefully everyone will see them distributed everywhere. And then software companies like Yardlink, which helps match up supply and demand for the construction industry. And also companies like CG Hero, which is a marketplace providing services to the computer graphics industry.
Okay. And what about some of the more established holdings within the portfolio? Any particular highlights?
Sure. Some of your viewers will be familiar with a number of the kind of stalwarts of the portfolio. Monica Vinader, which is a jewelry company, again, in the consumer side, has been doing incredibly well, benefited strongly from COVID tailwinds, but has also continued to do well over the course of this year. Bliss, which has been in the portfolio for probably over a decade now, has sold in the last year, and that generated over 6x on the total investment and a whopping 20x on our initial investment. And then some of the other companies in the portfolio that watchers might be familiar with would include companies like NPB, Papier, CreativeX, all of which have raised significant funds over the course of the last sort of 12 to 18 months.
It looks like Luxury Promise is doing pretty well as well.
Luxury Promise is doing phenomenally well. And some of your viewers might be familiar with Watchfinder, which was a business we exited a number of years ago that was doing pre-owned luxury watches. We've kind of taken that model and used it in a number of different sectors, including Luxury Promise, which is a similar model but for high-end handbags. And then even MPB, which I mentioned before, which is high-end high-end camera equipment resales.
So besides funding then, what do you do practically to help these companies succeed?
Sure. We've significantly expanded, I guess, what we would refer to as our platform for the portfolio companies. So we've added a head of talent in the form of James Adams, who comes from a wealth of experience in startup and scale-up companies. We have Henry Phillipson, who does PR and communications, both for us, but also to support the portfolio companies. And as I mentioned before, we also have the platform in the US to help companies expand into the US. And things we might do there would include commercial introductions to key customers.
That's quite a big thing in a portfolio, isn't it? If you look at some of the larger holdings, they've all moved over to the US recently.
It really is. I mean, for us, it's sort of our platform is the ability to identify companies that have capacity to move to the US and then help them to do so. It's not an absolute requirement, but it is a USP for us.
So does the current environment affect the way you're investing, or does it affect the companies you're backing at all?
It does. It impacts both. I mean, at the moment, I think the market for us is still a bit scattered. The public markets, we've seen tech multiples in the public markets fall to almost 75% lower than they were at the COVID peak. That hasn't quite happened in the private markets. We've seen a bit of stabilizing, but not necessarily the same rapid decline. That said, we didn't quite see the same heat in valuations that were in the public market. So for us on the investing side, we need to be incredibly disciplined about the incoming prices. And I would say one of the things that we are seeing is companies coming back. So where we've identified a business we really like, but we can't get comfortable with their valuation expectations, we have sensible conversations with them, and they might be coming back 6 to 12 months later to say, okay, we're still interested in the conversation. And then we're able to enter at a price that we feel more comfortable with. And then in terms of the way that we look at the companies managing themselves, cash has to be king right now. And so we look again back to, is there any cost rationalization that needs to happen? Doesn't necessarily mean massive cost cutting, but are we investing in the right things that have proven ROI in a very near term? And happy to say most of the companies really embrace that.
Okay. And have you felt the need to revalue the portfolio at all, given the wider falls in the stock market?
I think revaluation of the portfolios is a necessity. As I mentioned, 75% fall in the comparables means that by definition, the portfolio needs to be revalued. So yes, definitely. And what we're seeing is the underlying performance of the portfolio remains really strong. So if we look at the P&Ls and the growth rates, they are in some cases offsetting, in some cases more than offsetting the portfolio revaluations, but certainly not everywhere. We aren't necessarily recouping a 75% fall in public valuations that quickly.
Okay, so whilst the valuations might have come down, the underlying operating performance, you're not seeing too many changes there.
When we look at our valuations, we rank the portfolio on where are the movements coming from? Is it performance related, or is it public market or comps valuation related? And the vast majority is really the public markets rather than the underlying performance.
Okay. So what are the biggest challenges you're facing at the moment?
Uncertainty, I think, is probably the biggest challenge for everybody. The ability to maneuver quickly and to duck and dive is what's really important right now. And if we think about it, I think it's a difficult journey for an entrepreneur right now for a lot of our portfolio, but also the VC industry in general. What was being rewarded 18 to 24 months ago, which was growth at all costs, is now almost the opposite. And so for entrepreneurs, it's a bit of a whiplash journey for, wait a minute, I was doing everything right. Now I'm being told that what's being rewarded is something different. So I think for a lot of the industry, being able to maneuver quickly and to change the focus very quickly is almost more important right now.
And what are the key risks within the portfolio? For every 10 companies that you back, how many do you expect to fail? How risky is this?
Traditionally, we expect very few companies to fail. I expect more to fail this year. And we saw that in 2008-9. I think we had a couple of companies that failed, and then the rest of the portfolio quickly stabilized, and we saw growth and continued growth. And the few years following that, demonstrated some of our best returns ever. I expect the same thing to happen now. I expect more than average. I would say probably 2 to 3 companies to really struggle this year, and then a lot of the portfolio to stabilize.
You mentioned returns there. Quite often, returns for Proven means exits.
Yeah.
Any recent exits to talk about?
Sure. Actually, 22 has been a good year for exits. I did mention Bliss earlier, so we sold Bliss, which was a stalwart of the portfolio, and I think I mentioned the return on that was in excess of 6 times our investment overall, and then 20 times for our very initial investment. We also exited Zuvu, or we sold 70% of our interest in Zuvu, and that generated a roughly 4.5 times return. So we have seen some good exits. And I mean, in terms of the environment right now, it is a more challenging exit environment, but it certainly hasn't completely dried up. I think the IPO market is where it's extremely challenging, but traditionally we don't seek exits through IPOs. Most of our exits go to strategic investors or financial buyers. And at the moment we have a number of deals that are in terms with that area of the market.
So how are the VCTs performing as a whole?
We have revalued the portfolio down slightly, but as I mentioned before, I think that's when we look at the analysis, it's largely driven by the public market comps rather than the underlying performance. So my hope and expectation is, given the performance continues to be strong, we'll see quite a bit of that either offset or revalued again based on the performance outpacing the market falling.
Okay. And the outlook for dividends, what are you targeting? Are you confident you can achieve it?
We target 5% dividends. Obviously, there's no guarantees going forward, but traditionally we have paid in excess of 5%, even in challenging years. And based on the based on the portfolio performance and the recent exits, I expect we'll be able to meet that in future.
Okay. So Karen, to sum up then, I would like to invest in a VCT this year. Why should I invest in the Proven VCTs?
I think the Proven VCTs have an exceptionally strong and pretty consistent track record, and we do have a genuine USP in our ability to take businesses from Europe and help commercialize them into the US. One of the things we found this year specifically is that the markets have provided a bit of a natural hedge, not just from a currency perspective, but also we see, for example, the consumer demand in the US is still outpacing consumer demand in the UK, and that provides a bit of a natural hedge.
Brilliant. So Karen McCormick of Beringia, thank you very much.
Thank you so much, Jonathan.